Want to give you a better shot of the Dow 30 right now. We're down 28 points, but there's more companies in the red right now than more companies that are building. Having said that, Cisco is the drag right now, but take a look at who's leading, and that's Bank of America. We're up 49 cents, but, you know, okay, there you go, 6.79. Bank of America has had nothing but loss day after day. In fact, all the financials were moving higher yesterday, except for Bank of America. Amex, JP Morgan rounding out with Home Depot, your top four on the Dow 30. Also, gold is a big story today. Gold has been selling off, the contract selling off today, the contract selling off yesterday. I want to bring in right now, if we can, do we have Sandra Smith? Okay, we have Mark Matson. All right, Mark Matson, CEO and founder of Matson Money. Mark, you're with me first. I'm sorry, I was waiting on Sandra Smith and her gold trade. But let's talk about the markets, because if you look at the action, in particular in the gold market over the last 2 days, it seems like people are ready to go back into risk. They're looking at stocks again, and they're getting away from the safety play of gold. Do you think that we're having some type of shift right now with regards to psychology?
Well, we just finished a study of over 10,000 individual investors, and here's what we found out. The average investor right now across the United States has 70% of their money in fixed income. That's the real safety play. So they are afraid. If we went back just 4 years ago, they would have only 20% in fixed income and 80% in equities, which tells me that the average investor is doing the exact wrong thing. You're supposed to buy when prices are low, sell when they're high, and they're doing the exact opposite. They lost tons of money in equities. They're still not really ready to go into the market, and they're doing the results are disastrous for a long-term investor.
Jordan, that is difficult for the retail investor, because the retail investor is usually looking long-term, but they're seeing all this volatility, in particular over the last 3 months, and they're probably calling your office and saying, I want to make some changes. Are you having that right now?
There's a lot of hand-holding that's going on, sure, because certainly, you know, the individual investor, I think, is much more attuned to the news that goes on every day. Every day that the move in the Dow is on the front page of the New York Times, it creates another influx of calls. And so while investors, I think, intellectually understand buy low, sell high, invest for the long term, I think, you know, on an emotional basis, when they get their monthly or quarterly statements, when they see numbers on the front page of the New York Times or the Journal, it really creates this internal conflict with them, and they need to be reminded that you know, volatility is inherent in the markets, and over time, wealth can be generated with rational asset allocation.
And yet, Mark, one of the things that we're going to see come Friday is this speech by Ben Bernanke. It seems that a lot of equity investors are looking for him to maybe give them a Band-Aid, give some type of hint with regards to QE3. But if they don't get that on Friday, I'm concerned we're going to see volatility again, Mark. What do you think is going to happen?
Well, QE1, QE2 didn't work. QE3 won't work. Any investor that thinks that just because they came out, if they did come out with QE3, the market would go up or it would make it a better long-term investor is wrong. Look, the sooner that the federal government, the Fed, and the Treasury admit they don't know how to grow the economy, they don't know how to create jobs, the better off we're all going to be. We need a sound money supply so entrepreneurs know the value of goods and services. We can go to work and create the jobs, keep the Fed and the Treasury out of it.
Tyler, you're looking for volatility. You say that we might have some serious volatility on Friday.
Sure. I think there's no way about it we're going to have volatility. If you look at the last time he spoke last year, basically there was tightening that was factored in originally. So if you looked at futures markets, they were thinking going into that meeting that we were actually going to be tightening. Well, he came out and surprised about QE3. So that hit the markets. Money ran into risk assets that continue to push markets up. It's a lot different this time. People are almost expecting that QE3. And when he disappoints, I think it's going to be a problem. So, yeah, I think we're going to have more volatility. I think in the short term, this market is headed a little lower.
Mark, I know that you've got a lot of your clients that have been calling you. As Jordan just said, a lot of hand-holding is going on right now. I've heard that from several market analysts and strategists and money managers like yourself that have come on the show. What do you tell them if they're saying, I need the money in 6 months, I need the money in a year? What do you say to them?
Well, if they needed it in 6 to 12 months, it should have never been invested in equities to begin with. On average, our portfolios are 70% equities and 30% fixed income. And the beautiful thing about that is we educate the investor to understand the standard deviation, which is volatility, and the long-term expected premium for equities, so they get to make a choice that they're comfortable with. You shouldn't be listening to a money manager telling you that they can forecast the next 20 days or 20 minutes and moving your money in and out. You got to work with someone that's going to educate you to know what those long-term premiums are. And once you set it, you need to forget it and rebalance it.
Mark Matson, Matson Money, CEO and founder. Mark, thank you very much. Very good advice for all of our viewers at home. Well, after all of